Hey folks, welcome to another video by Stock Trades. My name is Matt, and today we are going to take a look at the earnings of Canada's big banks, the big six banks if you will, and have a look and see how they performed against expectations. Before we jump into Canada's bank earnings, you might recognize that I'm not wearing my usual Stock Trades t-shirt. Today I'm wearing an orange shirt. I'm doing that in light of the fact that this is the first time we've filmed since we've learned of the devastating news. The remains of 215 innocent Indigenous children were found in a mass grave on a formal residential school site near Kamloops. As Canadians, only now I think are we starting to recognize and understand that Canada does have a dark past, and it's important for us to acknowledge this. Truth must be told in order for reconciliation to happen. Truth, by the way, is what my t-shirt stands for. This truth design was created along with the Northern Ontario School of Medicine communications team and some community members, and it really reflects the 6 languages used in Northern Ontario to represent truth. Outlined is the Cree syllabics, and then the different languages and how we say truth were all built within the design. So that's the t-shirt that I'm wearing today. It's all about truth. And today I would like to take a moment of silence to acknowledge the innocent children who lost their lives and anyone else who may have been harmed by the residential school institutions. Thank you. Canada's bank earnings are always among the most scrutinized. Why? It's pretty simple really. They are among the best dividend stocks to own in the country, and they make up a large portion of investors' portfolios across the country. So naturally, investors pay attention. They are also a key bellwether for Canada's economy. So as banks do well, the Canadian economy also tends to be doing well. So over the past couple of weeks, all of Canada's 6 banks have reported earnings, and we figured let's take a look and see how they performed. First, let's start with a quick overview of their performance against estimates and provision for credit losses, which have been a hot topic of discussion over the past year. So across the board, banks crushed earnings as PCLs were revised downward in a big way. It's actually been quite a while since all of 6 Canada's big banks beat on the bottom line. In terms of revenue, only 3 banks topped estimates: the Bank of Montreal, National Bank, and TD Bank. It's worth noting that despite topping estimates, TD Bank's revenue fell by approximately 3% year over year, one of only 2 to see declining revenue. The other was the Bank of Nova Scotia, which saw revenue drop by approximately 3% itself over the second quarter of last year. Notably, both the Bank of Montreal and the National Bank of Canada saw impressive double-digit top-line growth. Both grew by approximately 16%, which by far eclipsed all of their peers. When it comes to PCLs, one thing was abundantly clear. The banks have a much higher confidence in Canada's economic outlook moving forward. For those that are unaware, PCLs are a forward-looking metric, and according to Investopedia, using their words, is an estimation of potential losses that a company might experience due to credit risk. So in effect, it's a guess based on the information available on the credit losses that they may take given the current market environment. At the beginning of the pandemic, the Bank of Nova Scotia stood out as it booked lower PCLs in terms of percentage change when all the other banks were far more conservative and booked much higher PCLs. Bank of Nova Scotia ended up making the difference in the following quarter, which would have been the third quarter of 2020, as it was clear that they had underestimated the impacts. Funny enough, this time around, the opposite happened. The Bank of Nova Scotia looks to be the most conservative bank, only dropping PCLs by 73% year over year. This time, criticism was pointed at TD Bank, one of only 2 banks to book a recovery in provision for credit losses. TD Bank went from booking a $3.8 billion provision for credit loss last year to a $377 billion recovery this year. That is by far the biggest swing among all of Canada's banks. So they've been criticized because they only beat earnings because of this pretty big and significant swing. However, the argument can be made that all of banks beat on the bottom line because of the big massive revisions to PCLs. Now, whether or not TD Bank will have to book higher provision for credit losses next quarter because they underestimated their PCLs, time will tell, and we'll find out next quarter. But for now, they do seem like an outlier, much like the Bank of Nova Scotia was an outlier last year. Since the banks have reported, most are in positive territory, but the Bank of Montreal and CIBC stand out with gains of approximately 4% and 6% respectively. On the flip side, TD Bank and National Bank are the only two to be sitting on losses of 1.1% and 4.5% respectively. Of note, the chart that you see in front of you is only reflective of results since the first bank reported, which was the Bank of Montreal. We can't overlay charts with different dates, so that's why it looks this way. But since TD Bank and National Bank have reported, they are both sitting on losses compared to the others. So which bank delivered the best results this past quarter? In my opinion, it's the Bank of Montreal. It grew revenue by 16%, which far exceeded expectations, and it delivered really impressive ROE. The Bank of Montreal was actually one of the worst performing banks at the start of the pandemic last year, but it roared back in the second half. Now it is continuing its strong performance, and I think the Bank of Montreal delivered probably some of the best results this past quarter. In terms of which one lagged, this is a toss-up for me between TD Bank and the Bank of Nova Scotia. I am going to lean, however, towards the Bank of Nova Scotia because their international banking segment continues to weigh on quarterly results. The international banking segment, which is primarily in Latin America, hasn't responded quite as well as North American operations. So that's why we think that it is currently holding the Bank of Nova Scotia back. That being said, it also might be the best opportunity. Why? Because since the international banking operations haven't rebounded as much as some of the others, it means they have higher upside. They still have plenty of room to recover, which may mean that the Bank of Nova Scotia might outperform in the second half here. Time will tell. Overall, the banks delivered very strong results. Across the board, I would think that it was a very strong earnings season for Canada's financial companies. And the good news is, Canada's banks still have room to run. Sure, if you're looking at their companies' price to earnings ratios, they do seem a little bit elevated against historical averages, but it's important to note that the current PE ratios are being negatively inflated because of the pandemic. My opinion, it's better to look forward. Now, on a forward basis, the banks are actually trading in line with historical averages, maybe at a slight premium, but nothing to be afraid of. We think that the current threat of rising rates and inflation is a boon for the banks, and we expect them to outperform over the second half of the year. After the second quarter results, I'm giving the edge to the Bank of Montreal, and I'm hoping that the Bank of Nova Scotia does eventually recover with their international banking segment, but until I see some notable gains in that area, it's going to continue to lag its peers. So let us know in the comments, which ones do you think performed quite well this past quarter, and which banks are you buying? Let us know in the comments below, and as always, please like our video and subscribe to our channel for more great Canadian content. Until next time.